I need to tell you about something happening right now that almost nobody is talking about. There's a vault buried beneath the streets of New York City, and inside that vault are the actual stock certificates that represent your portfolio. Yeah, the stocks you think you own? You don't really own them. Not in the way you think. Every time you buy shares through your app, you're getting a promise, a digital receipt. But the real asset, the actual certificate with legal ownership rights, that's locked underground with a company called Cede Company controlling it. Most people have never heard of them, but their name is literally printed on almost every stock certificate in America. Now here's what's wild. This system has been running since 1973. For over 50 years, we've been trading digital promises while the real assets sat frozen in a basement. And honestly, it worked fine for what it was designed to do. But something just changed. Last month, December 11th to be exact, the Securities and Exchange Commission issued a letter that's about to flip the entire financial system on its head. They greenlit a new framework, one that makes that underground vault and everything in it potentially obsolete. And there's a clock ticking. Second half of 2026. That's when the old system gets unplugged and the new one goes live for everyone. I'm talking about a $100 trillion migration, the biggest infrastructure overhaul in financial history, and if you're not positioned for it right now, you're going to watch from the sidelines while institutions print money. Let me be clear about something. I'm not here to shill you some random altcoin or tell you to dump your life savings into speculative garbage. What I'm about to show you is how the smartest money on Wall Street is quietly repositioning for this shift and how you can follow the same playbook. So what exactly is happening here? Wall Street is building an escape hatch, not to abandon the old system entirely, but to run both systems in parallel. Think of it like this. You've got the physical vault as your safety deposit box, and you've got a new digital layer that lets you move at light speed. Here's the best way I can explain it. Imagine you own a Ferrari. Beautiful car, sits in your garage, but every time you want to drive it, you need to file paperwork, wait 3 days for clearance, and hope nothing breaks in the process. Now imagine you could create a perfect digital replica of that Ferrari. Same car, same ownership, but this version exists in a video game where you can drive it instantly, 24/7, trade it with someone in Tokyo in 2 seconds, or use it as collateral for a loan while you sleep. The real Ferrari never leaves your garage. It's still yours. But now you've got this hyper-liquid digital version that moves at the speed of the internet. That's tokenization. You're not replacing the asset. You're creating a faster, smarter way to use it. And Wall Street is going all in because of one thing: trapped capital. Right now, when you make a trade, it doesn't actually settle for 3 days. During those 3 days, banks have to set aside billions of dollars just sitting there doing nothing. It's insurance money in case someone defaults or the trade breaks. That's dead capital, money that could be earning returns, funding loans, or generating fees. But instead, it's locked up as a security blanket. Tokenization kills that problem. When an asset lives on a blockchain, the trade and the payment happen at the exact same time, instantly. No 3-day wait, no billions in margin sitting idle. Suddenly, capital that was frozen becomes liquid, and liquid capital is profitable capital. The World Economic Forum ran the numbers. $20 billion in annual savings just from cutting out the paperwork and manual reconciliation. That's not a rounding error. That's the entire profit of some major banks. But here's where it gets interesting. The real action isn't happening with stocks yet. It's happening in the $10 trillion alternative asset market. Private equity, credit, real estate, money market funds, all the stuff that used to take weeks to move because of legal paperwork and manual processes. That's all getting tokenized first, and almost all of it is being built on one platform, Ethereum. Over 65% of tokenized assets are running on Ethereum infrastructure right now. Not Bitcoin, not some random blockchain, Ethereum. JPMorgan isn't experimenting anymore. They're moving $2 billion a day through their tokenization network called Kinexys. Every single day. This isn't a pilot program. This is production. BlackRock launched a tokenized fund last year. It's sitting at $2 billion in assets, and it's paid out $100 million in dividends. Corporate treasuries are buying Ethereum like it's going out of style. Strategy, the company everyone used to know as MicroStrategy, they're targeting 5% of Ethereum's entire supply. This is institutional adoption. Real money, real scale. But before you run out and ape into Ethereum, let me give you the reality check. Ethereum is the backbone right now, but it's not guaranteed to stay that way. We're in the middle of an infrastructure war. Every major bank wants the speed and efficiency of blockchain technology, but they also want total control. So what are they doing? Building their own private versions. JPMorgan's network? It's a permissioned version of Ethereum. They don't want the public, decentralized version. They want their own walled garden. Goldman Sachs is building their own platform called GSDAP. Why? Because they don't want to depend on anyone else's infrastructure. So here's the question. Do public blockchains win, or do private bank-controlled networks win? That's the $50 trillion question. And honestly, I don't know the answer yet. Nobody does. What I do know is this. Institutions have been building for this moment for 5 years. The SEC letter in December was just the public announcement. But JPMorgan started in 2020. BlackRock was moving in 2024. Retail investors are about to hear about this on CNBC in 2027 when all the easy gains are gone, but you're hearing about it now, 6 months before the 2026 rollout. So how do we actually play this? I'm not betting on one winner. I'm building a diversified position across 3 tiers. Tier 1 is 70% of my allocation. This is the no-brainer institutional play, the banks building the rails, JPMorgan, Goldman Sachs, NASDAQ selling tokenization software, BNY Mellon and State Street building custody solutions. These companies win no matter which blockchain ends up dominating. They're the infrastructure owners. They collect fees on every transaction. Low risk, steady returns. Tier 2 is 20%. This is my highest conviction pure play. Securitize. Securitize is going public in the first half of 2026. Expected valuation around $1.25 billion. Here's what they do. They're the company that actually tokenizes assets for everyone else. They're the ones powering BlackRock's fund. They control 20% of the entire tokenized asset market. They're an SEC-registered broker-dealer and transfer agent. They handle all the legal and technical complexity. And here's the kicker. BlackRock, ARK, and Morgan Stanley are rolling 100% of their equity into the public listing. Nobody's selling. That tells you everything you need to know about conviction. If tokenization scales to $2 trillion by 2028, like analysts are projecting, Securitize is the toll booth on every transaction. Tier 3 is 10%. The speculative play, Ethereum and strategy. Ethereum could go to 7,000 or 9,000 according to some analysts. It could also stall out if private blockchains win the war. This is the high-risk, high-reward bet. Strategy is even riskier. They're leveraged to Ethereum, massive share dilution, $3 billion in unrealized losses right now. But if Ethereum rips, this thing could explode. This is only for people comfortable with serious volatility. Now here's my golden rule going into 2026. I will not buy any tokenized asset unless I can verify I have a security entitlement. That means a direct legal claim on the physical asset sitting in that vault at 55 Water Street. If I can't prove that claim exists, I'm not touching it. Price exposure is not the same as ownership. Don't get caught holding a digital token that turns out to be worthless paper. Here's the bottom line. The financial system is being rebuilt from the ground up. This isn't some distant future. The production deadline is second half of 2026, 15 months away. You have 2 choices. You can be a user of this new system and pay fees to everyone else, or you can own a piece of the infrastructure and collect those fees yourself. Most people will learn about this in 2027 when it's already priced in, but you're here now. You've got time to research, build positions, and get in early. The difference between early and late isn't 20%. It's the difference between buying Securitize at $1 billion and buying it at $10 billion after everyone else figured it out. You can check out my detailed breakdown and current positions in my free newsletter. Links in the description. And just so we're clear, this is education, not financial advice. Do your own research, make your own decisions, but do it fast. The clock is ticking. I'll see you in the next one.